Well, ladies and gentlemen, welcome to the second panel discussion of our day here in Budapest. We've heard quite a bit about the sort of macro background and a lot of analysis, and all of those data are established. We've heard about geopolitics and geoeconomics and so on, and now we have a group of people who, one way or another, I mean both international and domestic, represent asset management firms, although they're not necessarily actually portfolio managers themselves, so they'll speak to their particular angle on the topics at hand. We're going to talk about investable securities. So this is portfolio investment in Hungary and in the region. We'll probably focus mainly on fixed income markets, but we can take a sidelong glance at equities markets too. And of course, as before, anybody who wants to join in from the floor, although I actually can't see anybody because I'm under these sort of floodlights. I'm not sure if it was like this earlier. Could we dim the lights a little bit, do you think? Whoever's got the switch. Otherwise, you'll have 6 blind people an hour from now. So let me introduce the panelists we've got here in no particular order, but to my immediate right, representing the largest local fund management operation, György Éder is the Chief Executive Officer of OTP. I'm going to try it. Alapkezelő. Alapkezelő, which means fund management, right?
Yeah.
Fund management. To György's right, we have Matthias Zeinitzer, who's a director at BlackRock for Central and Eastern Europe. He's director of iShares and Wealth, joining us from Vienna, I think. To my immediate left, Caroline Grady joins us from London. She's the head of emerging markets research at an outfit called Hive. And you sort of advise hedge funds and other alternative asset managers, don't you, on
hedge funds,
strategy.
Trading desks and real money.
Okay, great, okay. So we'll ask Caroline to tell us what some of her clients are thinking. Next to Caroline, we have Maral Shamloo, who is a managing director of fixed income and liquidity solutions at Goldman Sachs Asset Management, also joining us from London. And Kaan, Nazli, finally again from London, is a senior portfolio manager, so he really is a PM, an economist on emerging markets debt from Neuberger Berman. We do say Neuberger, don't we, rather than Neuberger? Neuberger, yeah, no, I thought so. It's the kind of American way of saying that. So, to move straight into the matter at hand, the openings, I mean, we could spend the whole hour talking about this, but I want to get some thoughts on liquidity and relative liquidity. Liquidity, obviously, the ability to buy and sell is always the crux for people who are investing in and trading listed securities. So I'd like to hear just briefly from people how they kind of score different markets and different instruments across the region. Obviously, we're not covering every single country, but the major countries, Hungary, of course, included. Where shall we start? Kaan, why don't we start with you?
Sure. I mean, of course, starting with the regional, first start to talking about the regional liquidity. We also need to look at global liquidity. Of course, 2022 has been a pretty difficult year for emerging markets. You had record outflows from the asset class, including some of the strategic mandates. And then 23, it's been really month-on-month type of trend. I mean, you did get a lot of outflows on a net basis, although the last couple of months we are getting, some better signs. And in fact, I think we are now something like 10 days of consistent inflows into some of the passive products, which is something that we didn't get used to seeing. Within that context, I think CEE obviously fares well versus the global backdrop, especially in the hard currency side, with more countries issuing in dollars over the past couple of years, including Hungary and Poland. Of course, Romania is a consistent issuer. The liquidity has remained there for sure, and the local asset management support has also been there as well. In the local side, local currency side, of course, there are differences between like the swap markets and the bond markets. But I would generally say that it's been, typically, in the global context, it's been an okay environment for liquidity.
Okay, good. György, you're obviously here and every single day focused on these markets. Your comment on liquidity and also perhaps the extent to which you might feel that, not only in Hungary perhaps, but that the actions and policies of central banks may have tightened liquidity somewhat in domestic markets. So speak to that, please, and then we'll hear from the others.
I would start with it's a long downward trend in liquidity coming from, or starting from 2008-9 in the local markets. Of course, every single bank cut the allocated capital to the trading desk. So that's why we felt that liquidity disappeared, and it's still going down. So I was on the trading desk in a local bank, and we felt the same even after the COVID crisis, and I can imagine what's happening now in the trading desk in 2022 when the yields went up significantly. Banking books and trading books are stuck with some inventories. So that's why, and they don't want these inventories because the funding is very expensive. So I can imagine that the liquidity is getting even worse and worse. I hope the best for the future, but I don't know what's going to change this.
But does it affect the way that you run your clients' portfolios? And in fact, if you wouldn't mind, just give us for those who don't know, myself included, just give us a sketch of how much of your assets under management is individuals' private savings and how much is institutional?
Institutional. Roughly 1/6 is institutional, the rest is in investment funds.
1/6?
Yes.
Yeah, 1/6, okay. And monetary policy across the region or in Hungary, I mean, well, not quite monetary policy, but the way in which banks, central banks, of course, most obviously the European Central Bank, but other banks have engaged in quantitative easing,
yes.
have bought.
That's the worst one.
Have bought, well, quite. So I was just trying to feed you that one. So comment, please, on how that has affected the markets, or indeed other aspects of market efficiency.
It's quantitative easing, and all these banking buyings, siphoned out a big amount of liquidity from the market. So, and we are still seeing that. So. Maybe it's going to change next year or in 2025, but we don't see the reason why. So the liquidity is in FX swap market, the liquidity is getting worse. What I'm hearing from my former colleagues and the portfolio managers, the only thing which is the only part of the market which still exists, what I heard, it's just the spot market, FX spot market. So that's why some fixed income portfolios are hedged back by the euro hub. So.
Maral, and actually György has interestingly just taken those of us old enough to remember, obviously not you and several others here, but to the time when banks, Goldman Sachs being a notable example, ran huge prop trading desks, and that is effectively no longer happens at all, is not allowed to happen. But your comment generally on the question of liquidity, and I know you do pay particular attention to domestic bond markets around the region, including in Hungary. So please give us a little bit of a, I started by asking for a bit of a kind of scorecard, but not out of 10, but just where do you see pockets of particularly liquid securities, and where is it a bit tougher?
Across the region?
Across the region, yes.
Right. So, I mean, to some extent, liquidity is related to the size of the bond market. So, obviously, a large economy like Poland is going to have a much more liquid bond market than, let's say, Hungary. And this is something that Hungary cannot necessarily do much about. It is a small open economy. I would say that in terms of bond trading, particularly for large asset managers like ourselves, having large positions could be challenging at times. I think, as Kaan mentioned, last year there were moments of sort of a lack of liquidity in the market. The domestic banking sector obviously was there to somewhat, and domestic financial sector, non-bank financial sector, was there to some extent buffer some of these sort of evaporation of liquidity, but it remains a challenge for a small open economy, and this is not particular to Hungary. In Czech, you have a similar issue in Romania at times. On the bond market, thanks to larger fiscal deficits, it is not as bad sometimes, and it is a bigger economy. But I think that, the bond market, at moments of stress, this becomes an issue.
I mean, obviously, a country can't overnight double the size of its economy or whatever, but in terms of more technical things that could be done to enhance liquidity, what might they be? I mean, is that perhaps sometimes a function of good investor relations or transparency, or simply bringing more people in, or diversifying an investor base, things of that kind?
Yeah, I think we ask debt management offices many conflicting goals. We ask the country as a whole to reduce fiscal deficits. Yeah. We ask them to broaden the investor base, so make every investment pot smaller, and then we ask them for more liquidity as well. So these are obviously cannot be achieved at the same time. And as you said, for a debt management office, taking the fiscal deficit as given, taking the size of the economy as given, I think there are a couple of things that can be done, and Hungary's had a very agile debt management office. One, to ensure that for its own sake, sort of there are sufficiently diverse pockets of funding that if liquidity dries up in one, particularly those who are more fickle, like ourselves, then there are other sources of funding.
And diversification of currency of issue, obviously,
is part of that.
Yeah.
Is part of that. And I think more on the very sort of technical aspects of liquidity, it is a little bit the regulation for the banking sector and non-bank financial sector that allows this market to be more liquid and allows there to be more secondary market trading. And I'm sure there are sort of best-in-class examples in Europe that every debt management office can look into.
Well, I'm going to ask more generally about if there have been regulatory shifts or shifts to the regulatory environment that have impeded or enhanced the investability of bonds in the region. But just really quickly to stay with you, Maral, it may or may not be public, but just put us a little bit in the picture of how, in terms of Goldman's assets under management, which is obviously squillions, what sort of proportion might typically be allocated to a portfolio, fixed income portfolio in this region? Is that a number you could give us?
Sure. So,
I mean, perhaps vis-a-vis Latin America or emerging Asia, or.
Sure. So the fund which I manage is a GBIEM indexed fund. So the region has a weight of, I don't know off the top of my head, but I would say 35, compared to maybe 45 with Latin America. And so that's the relative weight. And then the rest of EM being
it feels to me that you probably allocated something to this fund.
Yeah, absolutely. I mean, in the local currency benchmark, it's around 35%. Yeah. Of course, Turkey used to be considered a big part of that. It has shrunk. Yes. But also in the hard currency side as well, it's around 35% or so. Of course, I guess it's interesting. So, if you looked at, let's say, before 2020. 21, you would think of the CE region as the let's say, defensive area, especially in the hard currency side. Like you had also on the local currency side, a very low inflation. You had relatively loose, monetary policies. The yields were low. So if you were worried about the globe, you would necessarily, for example, go into Hungary, which didn't issue for years in external bonds, and that would be the defensive investment. Of course, COVID was a big shock, and then 2022 with the Russian invasion of Ukraine. I mean, that really brought back a lot of the, risks that we had maybe forgotten about on a regional basis. Of course, country by country, there's always a pretty vibrant news flow that keeps you busy, at night. So certainly that political risk, inflation, all sorts of volatility, in the market, that made investors more cautious on the region. But yeah, I mean, certainly I think, with the resumption of flows into the universe, I think, and with pricing having adjusted, I think there are still opportunities in the region.
I love the idea of flows into the universe. Where are they coming from? Another universe. Caroline, when we had a brief chat before, and I said, what's the sort of mood among the people you advise? Your response was broadly constructive. So, but could you unpack that a little bit more, please? I mean, what are the concerns of the people that you advise? And indeed, what do you advise them to be concerned about?
Sure. I mean, it sort of reflects back to some of the points mentioned earlier. I mean, Hungary had this very large current account deficit, largely driven by higher energy prices, and it is very rapidly shifting. You're right around sort of 2% of GDP deficit now, but because when people sort of compare this across emerging markets, it's still higher than the rest of the region. You'd had the sort of 4 quarters of recession, which only very recently we learned has ended. So it is very much a transition phase in Hungary. The start of this year, we had these very large external imbalances, both on the fiscal side and the current account deficit. And now it is really turning around, but the fiscal is coming a bit slower. And that's on the back of a public debt level that, if you compare across emerging markets, is actually still very high. So it is constructive. In terms of trade, are improving rapidly. Policy is heading in the right direction, but there are some concerns, I think, about policy predictability. But maybe just to quickly flick back to end this liquidity discussion. I mean, I hear the same comment from investors about the lack of liquidity as being a hurdle. But the other thing that's sort of specific to Hungary is the currency volatility. When we're thinking about local markets, and the volatility of the forint is quite a lot higher than the zloty or the Czech koruna, and that is something that policy can address.
Well, and we heard obviously from 2 very significant policymakers earlier this morning. Just not a kind of full commentary on everything they said, but were there some things that they said that surprised you? For example, were you surprised by the very open degree of what we've come to know as forward guidance that the central bank gave pretty explicitly this morning?
I mean, I think that's very helpful because there is quite a lot of uncertainty. And it's interesting, if you look at the swap market, Hungary has about 450 basis points of price cuts for next year, which is higher than anywhere else. And that's certainly feasible for the central bank to deliver, but it's how they do that. And if investors know it is coming, there was a bit of a surprise last month when we got the 75 bip cut. We weren't quite sure what size it would be. So the clarity we got this morning was certainly very helpful.
Yeah, well, I mean, Matthias, to turn to you, but before the actual question I'm going to ask you, were you surprised, and if so, presumably pleasantly surprised, by the very open kind of policy statements from the bank this morning?
I think in this situation, obviously, where we see that turning points are here already, you need to be, let's say, that open as a central bank. So I think we see that across, because everyone has the expectation that once this turning point is reached, that there will be a clear path in kind of easing and getting back to, let's say, a new normal, but still to a normal environment. So I think that's good. What is interesting also to see is obviously the growth projections. I think that's something also which will reflect in the retail market, meaning in, let's say, the broader economy will also reflect in the investment behavior, which I think is then obviously much more interesting also than for us, especially in my role.
Well, tell us a little bit about your role in a moment, but to lead into that, I want you just to give a kind of broad brush picture of how Central Eastern Europe, or at least perhaps let's say the Visegrad countries, the kind of core CE countries, how do securities, both debt and equity, how do they fit into a global portfolio, would you say?
I think it's going in the same direction as the question you had before, in terms of what is the percentage, how is the positioning. I think most of the players in the market are at benchmark level, right? I would also say...
Any reason to be overweight?
That's hard to comment, obviously, but I think...
Sorry, I know that's the question I was supposed to not ask
but let me put it this way. I think there is probably, if you look at the relative terms right now, no reason to really be strongly overweighted, although we have, let's say, the expectation in the market, and I think everyone in the room, that this easing will come. On the other hand, I think the CE region obviously plays a huge role in a global portfolio, and I'm kind of here agnostic in terms of equities and fixed income, because if you look back at macroeconomics, this is the region to grow, right? Also compared to other markets, we definitely see that these countries, and I'm kind of now saying 6 or 8, depending on how you count also Romania, Bulgaria, that these countries are the most, let's say, dynamic, right? Also in terms of really economic growth. And that's why I think there's a good reason to have it in a global portfolio.
And to pre-pandemic, of course, a kind of sustained golden period for many of these countries. Correct. In terms of stable 5-6% economic growth, and the biggest problem being labor shortage. I mean, that's obviously every problem's a problem, but labor shortage is a good problem to have rather than. György, looking at the, thank you very much. I mean, comment by all means on what you've heard, and I'd be interested to know what you thought of Barnabas Viraj's forward guidance. But as well as that, I want to ask you if you think, I mean, there are some very obvious global issuers of debt from Hungary. AKK, of course, is the most visible, and then there are some of the other big state-owned enterprises like MBM and others. But I'd like to know if you feel there are other entities that might issue bonds internationally. Of course, OTP itself, but others. So first of all, Barnabas, what do you...
Starting with the second question.
Oh, start with the second question.
Yeah. I don't think... I had a discussion with colleagues, and we tried to find good companies who are not cash-rich in Hungary and can go to the international market. We haven't found any. So state-owned entities and the sovereign will check the market, will come to the market.
So you've got Exim. Is Akos Dollar in the room?
Yeah, but he's SOE as well. So
he's SOE. No, but I was just thinking, so the SOEs in question are the Development Bank, Exim, MOL, and MVM.
Okay, MOL is private. MVM is rather state-owned.
Yeah.
But then and Exim and MFB is pretty much as a proxy of the sovereign.
Yeah. So, there's nothing outside that universe.
Apart from the banks, because of Maral situation, this year and next year they're going to be very active.
Yeah. Well, we're going to talk a lot about MREL in the panel immediately after lunch.
But going back to your first question, I think this sort of communication will help the Hungarian capital market if it's honest like this, and it's going to be transparent, and they're going to keep the cutting until at least the springtime. is going to have a huge impact on the FX as well, and it's going to be positive for the international investors as well. So it's going to be even easier for the A to go to the market and fund than to provide the funding.
Maral, a couple of mentions from other panelists here about Caroline talked about the surprise of the 75 basis point cut. Now the surprise has been taken out, hasn't it? So the clear policy statement looking forward. And as György says, perhaps that will help to diminish currency volatility. But what do you think, or comments from you on what Bandar said from the central bank's point of view about forward guidance, about where they've been, about where they're going? Was it all coherent and it all made sense to you? They're doing a good job?
Absolutely. I think MMB has really surprised us by staying on message and focused on inflation. Since I have started covering Hungary, really the face of Hungary has been AKK, MMB, and Ministry of Finance, and there has been a
they're all there.
Yes, exactly. And I think it was a really challenging period. It was a very, very difficult period for Hungary. And MMB at the end did what it was needed to defend the currency. I think when it comes to forward guidance, the way that I would think about it is that as an investor, I don't take a promise as a promise of outcomes. I take it as a promise of reaction function. So if you remember, on the other side, when MMB was hiking rates, at some point they had a big hike, and it was interpreted as the end of the hiking cycle. The markets didn't like it, and so just a week later, they hiked another 500 basis points. So the forward guidance, or what they told us when they told us they're done, if it doesn't turn out to be the right outcome, they change. So this is how I see Mr. Virag's discussion this morning. It is not that I promise you to deliver 9.5% interest rate in February. It is, given our current projections, this is the path that we're seeing. And I, again, given the experience of the last year, I trust that if this is not appropriate, time comes in February, MMB will adjust its policy as necessary.
Pragmatic, trying to give a clear guidance, recognizing that circumstances change.
Absolutely. I mean, this is the sort of central question of forward guidance in all central banks. It's not just a Hungary-specific question.
Yes, absolutely. It's the famous remark by an old English politician about, why have you changed your mind? And he said, events, dear boy, events. Kaan, let's switch the emphasis a little bit. We want to talk about the degree to which what I tend to call thematic bonds, so green, perhaps the most obvious, most visible, but also social bonds, sustainable bonds, sustainability-linked bonds, those kinds of structures. To what extent do you think they are an important aspect of investing in across the region, generally, and Hungary in particular?
Yeah, so I mean, definitely the sustainable bonds universe is, again, universe, is expanding at the expense of other universes.
Other universes are available. Yes.
I mean, clearly that's a prominent theme. And if I could give an example from the funds that we manage, so we run dedicated emerging markets funds, and if we spoke 5 years ago, I would tell you maybe 5% of our funds would have some sort of a very specific ESG focus. Currently in the hard currency space, it's around 24-25%. So clearly there is a lot of demand for fixed income funds that will integrate ESG
and sorry, that quarter of mandates, does that weighted particularly towards perhaps official sector investors or public pension funds, or Or what kind of investors emphasize that most? Asset owners, I mean.
Yeah, I mean, geographically, I think Europeans particularly.
Right, yeah.
And then I would say it's a combination of official sector and pension funds.
So your Dutch pension fund kind of...
Right, exactly.
Maybe a typical... Sorry, carry on. Yeah.
Sure, yeah. But it does, I mean, go beyond that. And then within, within ESG, which is obviously a very, wide umbrella, the actual sustainable instruments have also become much more prominent. I mean, if you look at the issuance trends year to date and also the 3 years beyond, and we had a lot of volatility in the period, about 15% of all sovereign plus quasi-sovereign issuance was carrying some sort of an ESG label. Of course, this is an opportunity, but also a risk too, because currently we are getting to the point that we have enough variety that we will be asked questions like, well, you invested in this green bond, but is it credible? Is there greenwashing, let's say, or is there, this focuses on, let's say, reforestation, but we would rather have something a bit more linked to energy consumption, like things like that. But it's certainly a very important growing theme. And with the European Sustainable Finance Disclosure Regulation, you also have a lot of paperwork, and in a way, the investors having to justify what type of sustainable to profile that the funds that they manage have. So, I mean, all going towards a positive direction, but I would say it's a very significant theme.
And obviously, in recent years, this market has grown and ballooned. Much more so in Western Europe than in Eastern Europe, to begin with, certainly. Is that balance now evening out a bit?
I would say...
both in terms of supply and demand, I think.
Initially, I think, in terms of supply, initially it was really driven by more Eastern European issuers, but over the past few years, Latin American issuers have caught up quite substantially. In fact, if you look at the sustainability-linked loan space or bond space, you do see various investment-grade Latin American issuers.
Well, my dear Chilean friends invented it.
That's right.
The first ones there. Matthias, let's unpack this a little bit. This whole world is a whole alphabet soup. You see here GSS, GSSS, ESG, all the rest of it. What are the risks of, I'm just going to put this bluntly, what are the risks of a lot of this just being marketing flim-flam? And you must examine that.
Now we have to be careful.
Very, very carefully before you invest or before you even consider investing.
Just for, let's say, as a disclaimer, we have later in the transition panel our expert here, so Anastasia Petraki. So I will kind of be very prudent now in what I'm saying, obviously. No, but jokes aside, I think you're right. It's a little bit tricky in terms of giving end clients, by that I mean, let's say, the whole spectrum of clients, being retail, asset managers, or even institutionals, a common sense and a common feeling about what ESG/sustainability is. So that's definitely an issue, which starts, and I would say that's probably more a problem of countries in Western Europe, by having different labels in each country, right? That makes it already very tricky, and not only, let's say, on the side of kind of launching funds or products, but even if you kind of do it on the fixed income on the bond side. So I think that's a tricky part, because each country has a different understanding, right? Historically grown what it is. I would like to also kind of take on the point of the demand, because you said what is the supply side. I'm happy to kind of cover the demand side. I think if you look, and I kind of separated a little bit in the two blocks, having the CE region and then let's say the rest of Europe, we definitely see that we had over the last, let's say, 3 to 4 years, a huge demand in Western Europe for sustainable strategies, meaning not only equity, because here it's quite simple, at least in an easy way to screen out and to do the first checks, but also on the bond side. I think that was, let's say, for broad, diversified portfolios, something you could do. If I talk to clients here in the region, and this is kind of including Hungary, but not only just Hungary, there's a certain criticism regarding that topic. There's a certain way of saying, okay, is it just marketing or not, right? So that's one of the questions we get. And then secondly, it's obviously also if you have a strong local bias in your portfolios, right, which Hungarian portfolios have, Polish portfolios have, it's quite tricky to implement that on a high scale, right, because the industries are not ready. We often hear and we see that the data is not ready yet, right, so you don't get proper data. And the last point is, there is no security in terms of what the regulator will tell you, right, so regulators are in these countries, I would say also in other countries, right? If I look at Austria, my own country, it's tricky to get really what will they at the end really control, what will they look at, what is what they want in that term. So I think demand side is here, let's say, very weak. On the supply side, in terms of general portfolios, I see in each country probably 1 or 2 players being very brave and very outspoken. With the learning, I would say after 2 years, okay, it did not change much. I did not collect a lot of money. So let's leave it with this 1 or 2 products.
Okay.
That's the situation.
Caroline, sticking with this topic, generally speaking, I mean, is it something that comes up a lot either in what you kind of push out or what you're asked to provide? And also, seems to me, you know, as a relatively close and long-term observer of these things, that the interest has possibly peaked in ESG thematic bonds. Certainly in some markets, I mean the US perhaps the most obvious, but it's a bit of an outlier in all sorts of ways. But what do you think?
I mean, to be honest, the clients we speak to is more on the local side rather than the external debt side. Obviously, it's an issue that comes up because the financing is important, right? And they can mix the financing whichever way you like. But I think you sort of broad global macro investors, especially on the hedge fund side, if the price is right and liquidity is there, they will look at it. But their mandates are not so.
It's
so
just a
geared
bond in the
towards
end,
that.
right? It's just money.
Yeah. Whereas on the asset management side, it's a bit different because it would be sort of dedicated money.
Yeah, that's true. Kaan, to give you a sort of not entirely hypothetical example, and then we'll move on to a different topic. The KPIs, the key performance indicator sort of structure of green bonds or social bonds versus the use of proceeds bond, which are more easy to understand. You know, I mean, is the has the new plant been built, sort of thing. If it's there, it has. But with the KPI stuff, it seems to me that there's bit of potential for people to be marking their own homework, you know. I mean, and to what extent, for example, did and you know, these are, you know, the guy is a friend of mine, the Chilean Treasury. To what extent did they, when they launched their sustainability-linked bond, did they model impact for the Treasury 10 years down the line, the potential impact, ranges of impact, if KPIs were met, if they were not met, if they were partially met? And before you answer that, just to give you one other bit of context, there's a sovereign bond came out of an African country where the social KPI was, part of it at least, one of the criteria was the number of hospital beds in the country. Now, I don't know if anybody from Goldman's or BlackRock or anybody else is going to go around, you know, counting the beds in country X. What's your thought on that?
Yeah, I think certainly, I mean, you raise very good points. I mean, we do have these sustainable instruments, and we do take the second-party opinions, like we would, let's, for example, look at a rating agency for,
with credit,
for the creditworthiness. Yeah, but we don't have, maybe to, throw a bit of a spin to Caroline here, but we don't have the third-party type of research that's yet available that can actually say, well, wait a minute, you actually did not deliver the hospital beds, or this is the wrong thing to look at, or this is not what should be achieved with this should not be the priority, etc. I think the market, I think the demand is definitely outpacing the supply here. Not only in terms of only issuance, but in terms of the availability of data, as also Matthias has pointed out.
Okay. György, I didn't ask you to comment on that, but that general field, but if you would like to, by all means do. But I want to move on to talk about, it's embarrassing because I can't see him because there's a big light behind him, but the AKK obviously is very much involved and moving spirit behind this event. Usually from international investors, gets pretty good marks in terms of as a DMO. How do you see, because you of course are here and you're investing in local currency government paper as well, and many of your customers are investing in the retail bond program, and then I'm sure you also have exposure to the international issuance that the AKK puts out. So what do you think of their performance? Are they transparent enough? Are they communicative enough? Are they willing to take criticism? Would you like to criticize them or praise them? But give us a little bit of a picture of how you see the sovereign funding effort in Hungary.
Okay, so let's start with the retail bonds. This is our competition.
Yeah, of course, But no doubt many of your customers will be taking deposits from the bank and putting them into retail bonds, but...
Yes.
Yeah.
It's a competition, but we totally understand this is part of the funding of Hungary. And it's a local funding, it's better for the whole country. And we do think this market is kind of saturated, so you can increase the size, but not significantly. But it's a good funding base. So I think it was a totally good idea because all the countries around us are following this. And Croatia, Poland, and every other countries in the region fund this very good funding source. Wholesale government bonds in half. I think they are following the market totally. They would like to know what is the opinion of the asset managers and the traders. So there is a communication between the AKK and the market participants. So I think it could be better, but it's okay.
Well, that qualifies as damning with faint praise.
No. I don't think the CEO, the vice CEO, and all the colleagues from AKK they're finding the good communication lines to find out what's happening in the market, and we are reacting, and we do think that it's a kind of a communication from both ways.
All right. Well, all three of you, of course, have regular communication with the AKK. Any comments? Any suggestions? Any criticisms? Caroline? Praise?
Zoltan's always on hand whenever I have a question.
Good. Does he always have the answer? Maral, any comments? I know you said to the finance minister this morning that Goldman's is a keen supporter of Hungary, by which I guess you mean you fill your boots with every new issue.
So I think that AKK has, on the communication side, actually has done a very good job for foreign investors in the sense of sort of transparency. Compared to other debt management offices, small things such as having everything ready in English, publishing everything in on your website, so it's not difficult to find it. Simple things like this, I think, go a long way in making life easier for investors. I would say one other thing that this is not just sort of from me, but I hear it from other debt management agencies in the region, is that they find the retail investment program that AKK has launched very successful, and a lot of them are looking to AKK. I heard directly from the Croatian debt management office. I have heard obviously from Romanians that they're looking very closely, and so I congratulate the AKK for their success in this area.
And you don't cry for the poor shareholders of OTP or other banks whose deposits are being funneled elsewhere.
That's a whole other topic which I would be very happy to discuss.
There was this extraordinary incident, wasn't there, early in the year when the Belgian Treasury said they would hit all bids for a retail bond program and sold 20 billion euros worth. And you know, if I were running retail banking at a Belgian bank, Banque Bruxelles Lambert, do they still exist? I've lost touch with Belgian banks. I'd be pretty annoyed. Kaan, any comment that you want to give? We've only got 5 minutes left, and we've got heaps of topics that we can address. Is there anybody in the audience who wants to stick their hand up and either, well, ask a question preferably rather than make a statement? No? Fine. Let's talk a little bit about domestic savings, and we discussed this last night. A healthy and modern and efficient buy-side structure is obviously very important to any kind of domestic capital markets development. One normally important pillar of that is a functioning pension system. And is there one?
At the moment?
Yes.
Yes, there is one, but it could be better. So, for example, so we have the state pension fund and we have the voluntary pension funds. So voluntary pension funds are getting more attractive for people, but not for people who should save money for the sake of the future. For example, young people. So young people, they don't care. So that's this
the
one.
Same everywhere. To be fair.
They told me that in Hungary it's even worse.
Well, I don't know.
But
everywhere always thinks it's even worse than
we
everywhere
were very
else.
happy to hear that the government is thinking about to help this part of the pension funds, and they are coming up with some good ideas. So it's good for the country. Of course, it's good for the business as well. But as I said, going back to the liquidity issue, if it happens and it's going to be a big real money fund in this sector, it's going to help the liquidity of the Hungarian government bonds as well, and even the rest of the capital market.
Yeah,
so
sure.
Maybe corporate bonds.
I mean, where in government, this is pure ignorance on my part, but where in government does that policy question sit? Which arm of government needs to take hold of this pensions question and stand it on its 2 feet?
That's a good question. The Ministry of Finance?
Yeah, well, they're usual suspects.
Yep.
But Matthias, your comments on this, and also whilst you're at it, just in half a minute or less, what kind of new investment products are you seeing people take hold of here? And particularly, and we've mentioned this in the context of the retail bonds program of the AKK, digitalization of investment. Just give us a quick tour d'horizon of that.
No, happy to do so. And I think here also we see in the CE region common trends across all of the countries we are looking at. I think what is important, obviously, is a functioning second pillar pension system. I think that's something we see if you look at the example in Slovakia, for instance, where you have, let's say, a strong second pillar also with a reform just came into force last year. We have other markets where it's a little bit trickier, that's clear. I think it's a combination of, let's say, having these pension pillars and then really what the retail client is doing on his own level. And here, I think, and that's the feedback also we get across the region, is there is this local bias you were mentioning, kind of local government bonds, having local equities depending on how large the equity market is. And then secondly, I think it makes sense to have a broad diversification into international markets. And the trends we see coming obviously from Western Europe and Germany or France and UK basically are leading in that, is to diversify very simply with transparent products like ETFs. Index products, ETFs. That's something which has in the CE region not been available all the time to the retail client, meaning registration, having all the pre-contractual materials in local language. But we're working on it, at least for our product range, to enable that. We did Czechia, Slovakia, Poland. And in December, we will also finish this exercise for Hungary and have 250 products registered here in the market. So I think that gives the retail client in Hungary the same opportunities to diversify their portfolios like someone in the UK, someone in France, someone in the Czech Republic.
Have you got some forms where people here can...
It's on
sign
our
up,
Hungarian
open an account?
webpage, so it's very easy to find
But
them.
what I found was absolutely fascinating when Matthias and his colleagues and I started talking is how many people do you employ in Hungary?
So in the Hungarian office, we have about 500 people. It's our tech and innovation hub for EMEA.
But it's a bigger number than that, I think, isn't it? That
I think here in the office, it's 500 to 600 people we have, and then the rest is in London and in other
No,
offices.
but I had a bigger number than... Anyway, never mind.
Okay.
I'm sure you know better than I do. Right, so we have precisely no time left, so that gives me ample time for my final question, which asset management people always hate this. Well, they don't really. They say they hate it. I want, just within the CEE universe, anything you like, bond, stock, commodity, whatever you like, government, private, bank. Kaan, you'll be first off the mark with this. Give me a long-short pair.
Yeah, so on the hard currency side, we've been focusing on a bit of the next generation CEE, so Romania and Serbia. It's, I mean, the EU funds are exceptionally strong theme for Romania, and actually, it's been a couple of years that we haven't heard any political crises, and the coalition has been stable and generally on track.
But if I want to
with
make
fiscal
some money by
consolidation.
Christmas, what am I buying? What am I selling?
I mean, I think it's still the double B space in the emerging markets that you would be looking at. So Serbia would be fitting in that in the hard currency, side. Yeah.
Okay, so we're buying Serbia and we're selling.
What are you? Well, that's a tough one. I don't think there are obvious, underweights in the region.
All right.
currently.
Okay, I'll let you off, Maral.
Yeah, so I'm going to answer the question in the way that I like. So, but addressing your question, I think that on the hard currency side, we see a trend which is moving away from what was the shiny part of the index for the past 10 years before COVID, lower quality but high yielding credit. We are really going back to bread and butter, sort of higher quality. And I think Hungary, CEE in general, particularly Romania, Serbia, Hungary, would benefit from this fact that there is a move to higher quality. So you have higher yields of investment grade, which provides, in our view, a very good hedge to, let's say, similar American assets, US assets, high yield corporates, because they provide you with geographical diversification. So I think that CEE is a winner on that front.
Yeah, the short part of your trade can be something outside CEE. How about that?
Exactly.
Yeah.
Well, then yes. So I would belong the sort of double B and triple B, higher quality double B and triple B on the foreign currencies side. And on the local side, I think CEE is still one of the regions that has a lot of cutting to do. So again, something to for bond markets to enjoy for the next 6 to 8 months.
Okay. Caroline, so if one of your poor hedge fund guys suddenly needs to find some more money to buy a turkey for Christmas, what is he going to buy? What is he going to sell?
So for me, it would be on the currency side. It would be long Polish zloty and short Czech. It was mentioned briefly earlier. I mean, we don't yet have the new government in Poland.
That's true.
We should have it by the end of the year. And so there's a lot of optimism around EU fund inflows, pick up in investment, and overall a much better relationship with the EU than Poland's seen in recent years.
And something weird might happen at the central bank?
I mean,
Let's not open that can of worms. We'll talk about that after lunch.
So we're very sort of bullish on the Polish zloty, and on the other side of it, it's more sort of policy choice from the Czech central bank. They need to loosen monetary conditions. They're the one central bank in the region that hasn't cut rates yet, so they're already doing it via weaker currency. And in the GDP data we got recently for the third quarter, Czech was very much the outlier, another negative Q-on-Q print. So that's the currency that's very much going to weaken, whereas Poland should strengthen.
Okay, great. Thanks. György. What are you buying? What are you selling?
I'm positive on bond market, especially on the mid curve, so around 5-year area, because interest rate cuts are coming. And I'm not that optimistic in the long part. Regarding what I would sell, I would be very cautious with currencies at the moment, because all the regional currencies, especially Hungarian forint, we see the budget deficit. We know that they have to cut rates. Central bank is very cautious, but they have to cut rates to help the budget deficit. And I would be a little bit more cautious on euro half.
Okay. As a private individual, Matthias.
No comment on that. But I can answer. No.
I mean, you say buy gold and sell, Estonia.
No, but I think the message should be in that way, because obviously there are other experts here on really kind of saying what is the pair trade. But I would say, obviously, I'm selling investment products to the region, so that's the clear point. Other than that, what I'm buying, obviously, and I think what also many asset managers do kind of for Europe, is that we are obviously still buying the growth story, which is in CE region, especially Hungary and Poland. I would say these two markets, in terms of investment penetration, in development of the investment market, also in terms of the perception and behavior of clients, I think these are the two markets where a lot will happen over the next 2 years. And I think that's an interesting story for everyone. And I think if this investment penetration is increasing, then it's helping, obviously, local government bonds, my colleagues from OTP Asset Management. So that's something which is helpful for everyone.
Okay, great. Thank you very much. Beautifully crafted, diplomatic answer. I'm sorry nobody in the audience wanted to join in. It's too late now. The one thing I don't have here is a clock, but I see we're only 4 minutes over. And in the meantime, join me in thanking these excellent panelists. Thank you very much, guys.